Today we're going to talk about the top 5 behavioral biases that can cause deadly mistakes for both traders and investors. Now, if you find this information informative, please subscribe to my YouTube channel and follow me on Twitter at CryptoQF.
R1, R2, R3.
Back with that buccaneers.
Again, thank you for joining me today. We're going to go over these behavioral biases. I'm going to tell you what they are, and I'm going to tell you how to avoid them. We're going to go this style, top 5, the 5 I believe that hurt investors the most, but there's plenty more out there that we will also get to. So let's jump right into it. So my first behavioral bias, and we're going to be going to do it very exaggerated here. Number 5 is anchoring bias. So what is anchoring bias? This means that you are fixated on a specific price or some prior piece of information. So for example, let's say I, CryptoQF, Crypto Quantamental, entered into a long position at any particular price and it went down. So I'm in the red, but I want to wait to break even or take a small profit. So I'm holding on to that position and I'm fixated on the price I entered into the position at. That's anchoring to a pretty arbitrary number, arbitrary price. Why? Because the market does not care at all about the price I entered a trade. A real world example would be price or salary negotiations. For example, if you went to a car dealership, you can see stickers on basically every car telling you what they're asking. Those prices are generally much higher than what they are willing to accept. However, they're trying to anchor you to that price. So what do you do to combat anchoring bias? There's a couple things you can do. First and foremost, you need to examine the situation from multiple starting points. So for example, back to me, CryptoQF, if I'm long a position that's red and I'm entering in a sell order at my buy-in price, I need to step back and say, hey, if I bought this a little bit higher or a little bit lower, or if I totally forgot about where I bought it, would I still be entering in this price? Would I be doing something different? And then also, it's very important to identify and diffuse the anchor. So for example, going back to the car price negotiation, you need to go up to the sleazy salesman and basically tell them, hey, I've done my research, I've looked online, I've looked at like truecar.com, whatever it is, and I know the real price of the car. So whatever you have on your sticker, it is totally meaningless. So basically you got to change and diffuse the anchor. So it's going to be a little theme here in this video. We're going to have some comics I think are pretty cool. So here we have Dilbert going in for a job interview, and the HR person or his boss, whoever it is about to make an offer of a salary of $27,500. Sorry about that. But Dilbert jumps the gun and says $5. So then the HR person jumps right in and says, okay, I think you're worth $5. Because what happened is they got anchored to the $5 and it went against Dilbert in this case. So let's move on to the number 4 behavioral bias that can cause deadly mistakes for both traders and investors. Here we have loss aversion bias. So what is loss aversion bias? There's been a lot of research out there, and basically people of all shapes and sizes, all races and religions, doesn't matter, you generally feel pain 2 times more than you feel the joy of gain. Now, I'll rephrase that. So if you lose something, that hurts twice as much than if you gain something of equivalent amount. So loss hurts more than gain. So what does this mean in terms of investing and trading? Well, one example you actually see quite a bit in crypto is, for example, take out my phone and I'm looking at crypto prices. I'm looking at stock prices and I keep doing it every 10 minutes. This crap is really, really volatile. So you want to keep looking to see if anything crazy happened. Well, since it is so volatile, it's very likely I'm going to look and see when it's down, when it's red, and that pain from seeing that red, that loss, is going to stick with me much more than equivalent gains. So what does that mean? What's the result of that? That generally means I'm going to take less risk. I'm going to under allocate to my risk tolerance, and that is definitely not a good thing. Another example here is people say it all the time. You haven't really lost any money until you sell your stock or your coin. Of course, that's not realistic. The reality is you have what the market is at that given moment in time. So that is loss aversion. So how do you beat loss aversion? Well, I think what you have to do is you have to have a discipline. You have to stick to it. So even though I might be ADD and check prices all the time, I have a strategy and a discipline based upon my quantitative model, which of course you can follow me on Twitter and get that every single day, that causes me to have the right amount of risk on. So no matter how often I see red, how often I check my phone, doesn't matter. I'm going to be fully allocated to my quantitative model, and that's that. Another thing it's really important is you need to identify your risk tolerance early on. Know how much you're willing to risk. Of course, you don't want to risk more than you can lose, but you also don't want to risk more than what you need in the near term. If you need to take your money out within 2-3 years or something like that, you need to reevaluate your strategy and what you're doing. So here I also have a comic as well. It's about a businessman who rightfully understands that in order to have big success, you need to take big chances and big risks. But somebody asked him, why aren't you doing that right now? Because of too much uncertainty. This is the definition of loss aversion bias. This businessman knows he needs to take risk, doesn't have a good strategy, doesn't have a good discipline, and he ends up under allocating to risk. So what is the number 3 behavioral bias? This is endowment bias. We see this all the time in both equity, stock, and crypto investing and trading. What does this mean? This means you irrationally value something greater due to the sheer fact that you own it. The fact that you own it causes you to like it more and value it more. In the reality, that's not the case. The value is whatever the market will bear. It's also called status quo bias and ownership bias. In crypto and in equity investing, you hear the term bag holder. Now, there's a few different biases in play with bag holders, but one is endowment bias. The stock or the coin is down a lot. You feel attached to it, you feel a sense of ownership to it, and you continue to hold it. Even though it probably makes a lot more sense from a strategy and a portfolio mindset to sell and reallocate, but you don't because you feel that sense of ownership to that coin. Here's another example in the real world. Maybe you're a fan of some soccer teams, football teams, baseball teams. Perhaps you even play fantasy sports. Generally, people tend to overestimate the skill of the players on their own team and underestimate the abilities of players in other teams, especially when you talk about like trade proposals and things like that. You generally feel like your players are a lot better, when in reality, if you step back and you looked at it objectively, it might not be the case. So how do you beat the endowment bias? You need to ask yourself, if you're 100% cash, so when you wake up in the morning, say this, say I had a clean slate, 100% cash, would I buy the same stocks and the same coins that I currently own? Now, of course, you got to take taxes into consideration, so it's not as clean cut as that. But would you buy the same coins, the same stocks? And if the answer is no, then you might be overvaluing what you currently own due to the endowment bias. So what is the number 2 behavioral bias that traders and investors fall victim to? Here I have overconfidence bias. So this means that you believe that you have more skill than you actually do, and you end up overestimating your ability. This is very similar to self-attribution bias, which is attributing something to your own abilities rather than its true cause. You see this often with equity fund managers, that they might have a great year, a great 2-3 years, and they think it's because they're great stock pickers. But if you peel back the onion, you'll see that perhaps they were just overweight a particular sector, a particular style that caused the outperformance, and they're attributing the outperformance to the wrong cause. There was actually a study called Behaving Badly, where 74% of fund managers actually said they were above average, and the remaining 26% said they were average. Of course, that's impossible because only half could be above average and the other half has to be below average. Therefore, clearly, these fund managers are suffering from overconfidence bias. So how do you beat overconfidence? I think the easiest is to be objective, to be real, and to use math. Now, as a quantitative, systematic, disciplined investor, that's easy for me to say. But generally, if you're using math, you can feel a lot more confident and comfortable in your allocations because you're focused on things like confidence and probability and things like that. And as an example, I have a quote here from Charlie Munger, which is one of the best fundamental analysts in the world. And he even says, one standard antidote to foolish optimism is trained habitual use of simple probability math. Now, not all of us are good at math, not all of us even like math. So another way to combat overconfidence bias is via introspection and perhaps even things like checklists. So you have a checklist for your trades, checklist for your portfolio, or anything you might invest in, and go through it and make sure you're not missing anything and not, believing kind of your own hype. A couple comics here. The one on the left is very much like the Behaving Badly research piece, but the one on the right is pretty funny itself. So one person is asking his either financial advisor or fund manager, whatever it is, do you believe in luck? And the fund manager says, basically, I only believe in bad luck. How else can you explain when I have losses in the stock market? And of course, this is overconfidence bias because he didn't say, I believe in good luck. How else can you explain my gains in the stock market? He's attributing that to himself, which is a clear sign of overconfidence bias. So let's jump into the numero uno behavioral bias that causes deadly mistakes for traders and investors. Here I have confirmation bias. So what is confirmation bias? Let's take a look at the comic right out of the gate. So you have one person saying, hey, please define bias, and the other person says, after a careful review of the facts, which results in any viewpoint other than my own. So basically anything that disagrees with this person is wrong. Therefore, they're seeking out confirming viewpoints, the clear definition of confirmation bias. So what it is, again, seeking information that confirms their existing opinions. It can be very similar to anchoring in some cases. It's ignoring useful facts and ignoring differing opinions. So here's an example. Say you're bearish on a particular stock or a particular coin, and you might actually search for reasons to continue to be bearish. Like, for example, you look at a chart and you try to come up with negative technical outcomes, whether you're looking at a negative candlestick pattern or a negative, perhaps like moving average crossover or something like that. That could be very negative. Or if you're a fundamental analyst and you're negative or bearish on a stock, perhaps you jump on Google and you search for the stock in bankruptcy or negative reviews or whatever it is, and you just try to confirm your opinion. Kind of in real life, perhaps you have friends, wife, girlfriend, husband, boyfriend, whatever, they want to go to a particular restaurant. And instead of being objective, you just look up reviews and you relay the negative reviews to your significant other or your friend. That's, again, confirmation bias. So how do you beat it? You need to force yourself to present the contrarian opinion. So when you enter into a trade or make an investment, ask yourself, what's the bull case and what is the bear case? And it's also very important to develop a wide range of sources. I'm a quantitative systematic investor at heart. Plus I do other things, but it wouldn't do me any good just to follow and talk to the exact same people. If you're a Warren Buffett disciple, probably shouldn't just read Warren Buffett books and do the same thing over and over. If you're an Elliott Wave analyst, perhaps you shouldn't be just following and talking to other Elliott Wave analysts. You should have a wide range of sources and get differing opinions. So that is the top 5 behavioral biases. To sum up, You have things like the endowment bias, confirmation bias, overconfidence bias, anchoring, and loss aversion. However, that is not all, folks. To kind of continue the comic theme, there's actually many other biases. In reality, I listed the top 5 that I think are very important, but any one of these can cause a major problem or a deadly mistake in your portfolio. For example, take the disposition effect. It's very similar to the endowment and loss aversion effects. What does this mean? That means you sell winners and hold losers. How do you combat it? You need to constantly reevaluate your portfolio from scratch. So basically, go back to the example. What if I hold 100% cash, but I still own this portfolio? Mental counting is a very big one. I easily could have put that number 1 on my list. What this means is that you segment your portfolio into different parts, separate parts, instead of looking at your portfolio holistically as a whole. Generally, you see this all the time. You might own 20 stocks, 10 coins, whatever it is, and you focus on 1 or 2 that lost, the one or 2 that won, instead of looking at the whole thing. The reality is each piece has a purpose. Some zig, some zag. A prime example here would be stocks and bonds if you're looking at it from a 30,000 foot view standpoint. Generally, when stocks do really well, bonds don't do too well. But when stocks crash, bonds do pretty well. And that's the entire purpose. That's risk management from a very high level. But what happens if you segment your portfolio just looking at your stocks and just looking at your bonds separately? Well, on your bond side, you would be much more likely to take on more credit risk, buy more corporate bonds, and be a lot more risky. Because, why else would you just want interest rate risk? That might not do too well. But the reality is if you take that credit risk, that buy those corporate bonds, when the equity market tanks, you're not going to get the same protection. That's why it's very, very important to look at your portfolio holistically. Recency bias is another behavioral bias that does quite a bit of damage. This is chasing whatever happened very recently. You see this in terms of pump and dumps, things like that. Very much momentum chasers. That could be good at times, but you got to have a rational reason. That's why you need to be objective, and math really helps here. Look at the probabilities, look at the confidence, things like that. Another bias is oversimplification. The reality in life is, whether you're looking at the equity markets, crypto markets, currency markets, doesn't matter. We're taking something that is very, very complex, and human nature is to try to narrow it down to a very simple problem. But it's not simple. Despite whether you might see on CNBC or Bloomberg, they might try to say, oh, the stock market went down because of this reason, or the crypto market's up because of that reason. That's not usually the case. It's usually typically much more complicated than that. So keep that in mind. And how to beat that is you must remain disciplined to your strategy. Don't deviate it. Don't oversimplify what's going on. Just stick to your strategy and you should be all right. The final 3 behavioral biases I have on this PowerPoint is we'll start out with herding. So what is herding? That means you follow the crowd. For example, you see this in crypto all the time. A bunch of influencers might turn bullish, therefore everybody else turns bullish, or vice versa. A few people turn bearish, then all of a sudden everyone else turns bearish because they want to basically be cool. They want to follow the crowd, and they're listening to the wisdom of other people. And all of a sudden, everybody is in a matter of groupthink. That is certainly not a good thing. Again, if you stick to your strategy and remain disciplined, you can avoid this. Another bias is being too familiar with stuff and only investing or trading in what you are familiar. For example, here I have, say you're a chef, you love to cook, and you just invest in restaurants, your favorite restaurants. That is a very poorly diversified portfolio. For example, say you're in Silicon Valley and you just invest in tech stocks. Again, that is a very poorly diversified portfolio, and that's not what you want. You want to have a broadly diversified, generally multi-asset class portfolio in things that you're familiar with, but also things that you're not. And you can outsource that to fund managers or just passive ETFs, whatever it is, but it's still very important to be broadly diversified. And the last one here is hindsight bias. What is hindsight bias? It's very similar to overconfidence bias. You see this quite often, especially with kind of back testers and things like that, where they might pull up a chart and say, hey, if you just followed this moving average over the past year, you would have killed it. You would have got every inflection point right. You would have sold at the top and you would have bought at the bottom. But the reality is that's not necessarily the case. It's just a certain time frame, and you're just looking back in hindsight. When you look back in hindsight, you're always going to see patterns. You're always going to see an indicator that would have worked. The reality is you need to have a much more mathematical approach, much more objective approach, and test the statistical significance and get confidence intervals and do various things like that to know if the signal or indicator that you're looking at or the model that you're testing is actually designed to do well in the future. But generally people don't do that. They just cherry pick a certain horizon, a certain indicator, and they just fall for the pattern. They fall for the hindsight. That is very, very dangerous. So guys, thank you for joining me today. We went through the top 5 behavioral biases. I told you what they are. I told you how to beat them, and I gave you many other examples of behavioral biases. Hopefully this helps you become a better portfolio manager, better trader, better investor, whether it's stocks, crypto, bonds, currencies, commodities, does not matter. We all fall victim to behavioral biases. The first thing, you got to be aware, and then you have to have a process to help eliminate them. So if this helped you become any better at trading or investing, please subscribe to my channel at Crypto Quantamental, and also follow me on Twitter at CryptoQF. I really appreciate your time, and thank you.